Hi class, a pleasant day to everyone. This is your Prof. Sir Dan. And on this video, we are going to discuss financial analysis and in particular financial ratio. On previous videos, we have already learned the four categories of financial ratio. We have learned profitability ratio and liquidity ratio on the previous videos. And for today, we are going to discuss operating ratio. And after this, the solvency ratio. Okay? So class, our topic is operating ratio, which is also called turnover rates or management efficiency ratio. Okay, let us discuss what are the types and uses of operating ratio. Operating ratio is also called turnover rates or the management efficiency ratio, and it complements the liquidity ratio. Operating ratio measures liquidity by how quickly a company can convert receivables and inventory to cash. Operating ratio measures efficiency in using resources. The higher the ratio, the more efficient. Class, please take note that if the ratio involves, which is in the case of operating ratio, it involves an income statement value and a statement of financial position value. And under operating ratio, we will include accounts receivable, inventory, and total assets in our ratio. So class, in operating ratio, because it involves a statement of financial position value, we have to get the average of the statement of financial position value. And the average is computed by adding beginning and ending divided by 2. The reason so is that because the income statement item pertains to a whole period's activity. So we also have to express the statement of financial position as the whole period's activity by adding the beginning and ending divided by 2. Okay? There are different ways to measure operating ratio. The first one is accounts receivable turnover. Accounts receivable turnover indicates the average number of times in a year a company collects its receivables. Accounts receivable turnover measures the efficiency of extending credit and collecting the receivables. A high ratio implies efficient credit and collection system. So the formula for accounts receivable turnover, this is expressed in number of times, okay, is sales on account over average receivable, okay? And the next operating ratio is days receivable outstanding. This is in relation to the accounts receivable turnover. So days receivable outstanding, it measures the number of days. Yung ART, number of times. So here, it measures the number of days it takes a company to collect receivable. So receivable outstanding is also known as receivable turnover in days or the collection period. Of course, the shorter the collection period or the days receivable outstanding, it is better. The formula for DRO is number of days in a year, which is 365 days, over the ART times, okay? So your denominator is the accounts receivable turnover number of times, okay? And this is what you are computing in the formula number 1. Some companies are using 360 days instead of 365. It depends on the practices of the company. Next is inventory turnover. Inventory turnover, or with acronym IT, indicates the efficiency in managing its inventories. Inventory turnover represents the number of times inventory is sold and replaced. A high ratio indicates that a company is efficient in managing its inventories. Okay? So IT is expressed in number of times. The formula is cost of goods sold over average inventory. Okay? And days inventory outstanding is our 4 turnover rate. It represents the number of days inventory remains unsold in the warehouse. It is also known as inventory turnover in days. In other words, inventory turnover in days measures the number of days from purchase of inventory up to the time it is sold. Okay? Like the days receivable outstanding, the shorter the days inventory outstanding, the better. So the formula for days inventory outstanding is the number of days, which is 365 days, divided by the inventory turnover number of times. Okay? Let us move on. Next is total assets turnover. Total assets turnover measures overall efficiency in generating sales using its asset. The formula is similar to return on assets, except that under total assets turnover, the one that is being used is the net sales. For return on asset, it's the net income. So the formula for assets turnover number of times is net sales over total or average assets. Total average assets. Okay? And we can get the days asset outstanding. It represents the number of days asset was used before sales is generated. So the formula for that is 365 days over the asset turnover number of times. The last method is, or the last way of determining operating ratio is the operating cycle. Okay, operating cycle measures the number of days a company makes one complete operating cycle. When we speak of one complete operating cycle, we mean that it is the number of days from the purchase of inventory, sale of inventory, and collection of accounts receivable. So it means that how many days it will take from the time that you bought the inventory up to the time that you have sold it in, or you have sold it and then collected the cash for that sales. Okay? So a shorter operating cycle means that the company generates sales and collects cash faster. Okay? So the operating cycle formula is the days receivable outstanding plus the days inventory outstanding. Okay? So you will get the number of days that the inventory is outstanding and the number of days that the receivable outstanding. So the total number of days for these two will be your complete operating cycle. Okay? Now let us do the summary of formula. Okay, for the we will have the number of times and the number of days. Okay, for accounts receivable, we have the accounts receivable turnover and the number of times. The formula is sales on account over average receivable. And if we are going to get the number of days, we have days receivable outstanding is equivalent to 365 days over average, oh, I'm sorry, accounts receivable turnover number of times. Okay, for inventory, we have inventory turnover number of times, and the formula for that is cost of goods sold over average inventory. And for the days inventory outstanding, the formula is 365 days over inventory turnover number of times. And for assets, assets turnover number of times is equivalent to net sales over average assets. And for days assets outstanding, 365 days over assets turnover number of times. And for the operating cycle, our formula is days inventory outstanding plus days receivable outstanding. Okay, now let us have our illustration. We will illustrate first accounts receivable turnover and days receivable outstanding. So our formula for accounts receivable turnover, as we have discussed, is equivalent to sales on account over average receivable. And we know that our average receivable is the beginning receivable plus ending divided by 2. Okay? And for days receivable outstanding, our formula is 365 days over accounts receivable turnover number of times. Okay? As we have discussed, some are using 360 days instead of 365. So class, for this, since we will be needing sales, we will be needing the income statement, and the since we will be needing receivable in the formula, we will have to look at the balance sheet or the statement of financial position. Okay, so let us compute the accounts receivable turnover for 2018. So the formula is sales on account over average. So our sales on account for 2018 is 1,310. By the way, the amounts are expressed in supposed to be hundreds. It should be in thousands, okay? But for presentation purposes, we will just be using uh, we will discard the thousands, okay? So here, 1,310 as the sales divided by, it's supposed to be average receivable, okay? Since we don't have the beginning because we don't have the 2017, okay? These are all ending amounts as of 2018 because it's December 31st, 2018 and 2019. So these are all the ending amounts, okay? So in as much as we don't have the beginning, we will just use the ending of 2018, which is 94. Okay, so our accounts receivable turnover is 13.94 and it has to be expressed in times. And to get the days receivable outstanding, it will be 365 days over 13.94 times, and you will get 26.18. Or it is better that in rounding off the days, it should be rounded up to the next day, which is 27 days. Even how small, for conservatism principle, we have to round it up to the next day, okay? So here, the days receivable outstanding for 2018 is 27 days. For 2019, okay, we will have sales on account, which is 1,460 over average receivable. And if we will look at the statement of financial position, now we can have average. We have the ending on 2019 as 110, and our beginning for 2019 will be the ending of 2018, which is 94. So in this case, we can compute the average. And doing the mathematical calculation, our accounts receivable turnover is 14.31 times. So to compute the days receivable outstanding for 2019, it will be 365 days over 14.31 times, and it will give you 25.51 or 26 days. Okay, let us move on. And now we will be discussing inventory turnover and days inventory outstanding. And our formula, inventory turnover, is cost of goods sold over average inventory. And you know that the average inventory is computed by adding beginning and ending and divided by 2. And for our days inventory outstanding, our formula is 365 days over inventory turnover. Okay, this is supposed to be inventory turnover number of times. Okay? Okay, class. And let us correct that formula. Okay? And then some again are using 360 days instead of 365. So we need the income statement because we want to determine the cost of goods sold. And we need the statement of financial position because we are looking at the inventory. So to calculate it, okay, inventory turnover in 2018 will give you your cost of goods sold of 980 divided by the inventory. In this case, for 2018, we don't have inventory beginning, so we will just use the ending of 2018, which is 240. So we will be able to compute 4.08 times. Okay? And for our days inventory outstanding, so it will be 365 days divided by the inventory turnover number of times of 4.08, and you will get 89.46 rounded off to 90 days. And for 2019, okay, we will have the cost of goods sold of 1,080 and divided by the average inventory, which in this case we already have the average because we already have the beginning plus the ending of 280. Getting the average, you will have, doing the mathematical calculation, you will have 4.15 times, and if we are going to calculate days inventory outstanding, you will have 365 days divided by inventory turnover of 4.15. This will give you 87.95 or 88 days, rounding it off. Okay, class? Now let us continue, and we are going to discuss asset turnover and days asset outstanding. And the formula is net sales over average assets. Again, in computing the average assets, you have to get the beginning plus end divided by 2. Okay? And for days asset outstanding will be 365 over asset turnover. Okay, class? And we need the income statement and the statement of financial position. Okay? So substituting the values, okay? So here we have net sales, which is 1,310, and divided by the average assets. For 2018, we don't have the average because we don't have the beginning. So we will be using the ending of 2018, which is 658. So with that, we will get 1.99 times. And then get the days asset outstanding will be 365 days divided by this 1.99 times. It will give you 183.41 or 184 days. Computing the assets turnover for 2019, you have the net sales of 1,460 divided by the average assets. In this case, we can now compute the average. So 658 plus 730 divided by 2, and that will give you 2.10. Okay? Meaning 1,460 divided by this average, you will get 2.10 times. And getting the days asset outstanding, you will have 365 days divided by 2.10. You will have 173.81 or 174 days. Okay? Let us move on. Operating cycle. Operating cycle is days inventory outstanding plus days receivable outstanding. We have already computed this in the previous slides. So we'll just present the computation for 2018. Okay, we have this. We were able to compute the days inventory outstanding at 90 days. Okay, and for days receivable outstanding, we were able to compute 27 days. So it means that our operating cycle for 2018 is 90 days plus 27 days. It will give you an operating cycle of 117 days. It means that it will take 117 days from the time that you purchase the inventory up to the time that you sold it and up to the time that you have collected it. It's a complete cycle, okay? Then for 2019, we have already computed this. So for 2019, our days inventory outstanding is 88 days. And for our days receivable outstanding, it is 26 days. So adding the two, days inventory outstanding and days receivable outstanding, we have 114 days for 2019. So it means that we are better, okay, our conversion of cash from the time that we purchase inventory up to the time that we have collected cash, it is better in 2019. Okay, class? Any question? Please let me know if you have questions. And I hope that you are all safe and you are all in good condition. God bless you all, class. Still next video.